The broader market outperformance has been the key highlight, wherein we have seen a lot of stocks sitting at 52-week higher levels, and probably that's going to be the trend today as well. The SGX Nifty as well as the pre-open rates were suggesting that it's going to be a bit of a muted start. We'll start below 18,600, but where we go from there is the crucial factor to watch out for. So let's see how those rates are panning out at the first stick. As far as Nifty is concerned, it's at least open in the green, now flattening out a bit. 18,540 is where we are at. So it's gone into the red with that open itself. The Sensex is now down almost 50 points, and the Nifty Bank 2, as usual, is in the red. But look at that advance decline ratio for you on the screen. There are 1,000 stocks advancing to 300 stocks declining, and that is telling you that there's a lot of momentum in the mid-cap and the small-cap space, and that's something which is very, very positive for the market. It's IT which has started right there on the front foot. So Tech Mahindra is higher by 0.5%. TCS, with the new CEO coming over from today itself, is also seeing quite a bit of positive momentum, so 0.6% higher for TCS as well. You have Infosys, all of the counters are actually comfortably in the green. The next space which is seeing a bit of attraction is financials, in the sense of Axis Bank as well as HDFC Limited. So both of these counters are in the positive. Even metals have actually opened with the green. In fact, all the sectors seem to have opened in the green. It's Hindalco which is higher by 1%. Jindal Stainless is also doing its bit. And if you look at the stock-specific action on the losing side, of course, Coal India is seeing that technical reaction as we pointed out. So that stock is down in the trading session. Gujarat Gas also, the increased competition coming in, is seeing a cut. Kotak Mahindra Bank is in focus as well. You also have Bharti Airtel, which was seeing a very, very volatile move in the last 15 minutes of the trading session yesterday. That continues to be quite volatile. In terms of the gainers, however, Adani Group of stocks, so Adani Transmission, Adani Green, they are the couple of names, and then Indus Tower as well. I also wanted to check on what's happening with Union Bank, because there was a big brokerage note coming in this morning talking about a bit of a downgrade. Let's see if there is any reaction on that counter. For now, it's holding up with just a 0.5% gain. Escorts is the other one, wherein I think the numbers just came with respect to the auto data. That's seeing a bit of a momentum pickup when it comes to the volume. But overall, have to say, Avan, it's not a very bad opening. 18,550 is where we are, and very impressive advance decline.
It's actually the small cap end of the market that's showing you traction, if at all. 0.7% gain. Adani Transmission, RITES, Cyient, Zensar Tech, Sequence Scientific, RHI, Magnesita, TCI Express. Those are some of the stocks that are looking pretty resilient on the screen. We're calling it not a bad start. Kunal, would you beg to differ, or do you agree?
I think it's a good start for the indices, even because after yesterday's handover, if we are opening flat on the Nifty and the Bank Nifty, that would probably be a very good sign. And the action is more stock specific, because a lot of stocks which are riding on high momentum, there seems to be a good follow through up move for these names. Now the stock which I would look to trade in the open would be Mahindra and Mahindra. Looks extremely attractive. The stock coming back to that 1300 plus mark. I think over the last couple of days there's been very good signs of momentum getting renewed for Mahindra and Mahindra, and that's a stock which I would be keenly tracking on.
Okay, M&M, that's a stock that you're tracking this morning. Naresh, what about you? Naresh, you need to unmute yourself.
That would be Bharat Forge. The stock is setting up for a short-term breakout, so it looks pretty promising for a move towards 900 in the short to medium term.
So that's the first trade coming in from Naresh as well. But let's welcome on board Nilesh Shah, the MD and CEO at Envision Capital, joining us on the show. Nilesh, hi, good morning. This is Anisha this side. Just wanted to begin by taking your view as far as where the market is headed. We were having those all-time high level insights, just 100, 200 point away on the Nifty. Do you see that happening soon in the month of June itself?
Yeah, I think it's a great opportunity for the markets to advance further. We've had some strong tailwinds in terms of the macro data which has come out. We've had some solid growth. Inflation is tapering. So pretty much looks like a Goldilocks situation from a macros perspective. We've just completed the earnings season. I think it's been a great close to the quarter, great close to the financial year from corporate India. The liquidity overhang which was there in terms of the FPI selling most of late 21 and 22, that trend has reversed and they are net buyers. So on the whole, I think a solid set of fundamentals and strong liquidity, I think, are the perfect kind of tailwinds that the markets would really look forward to. And post the market consolidation for the last 18 months, the valuations also have turned relatively reasonable. So on the whole, great fundamentals, solid liquidity, and reasonable valuations. I think that really provides a lot of support and a lot of push for the markets to continue to move forward.
Fair enough, Nilesh. Hi, morning. What do you think is going to be then the next big trigger that the markets will watch out for? Do you think it's largely likely to be domestically led back home, or do you think that it'll be a combination of factors from across the globe as well?
I think it's going to be a combination of all. I think we are today relatively spoiled for choice because the domestic growth momentum is very solid. There's strong growth that we are seeing essentially in a lot of discretionary consumption items. The investment and the capex cycle, which is still kind of just begun, is showing against very, very strong momentum. So you have both discretionary consumption as well as the investment and the capex cycle, which essentially are unfolding. In addition to that, if inflation has started to moderate, it's quite possible that we are already on a pause mode, and if the rates start to decline, that will give a further boost to a lot of rate sensitives like real estate, automobiles, and some of the other rate sensitives. In addition to that, from a global perspective, while there is a slowdown and there will be challenges in terms of exports, but selective pockets across the board, I still think are poised to do well. Some of the companies have evolved some really specific business models and are making them increasingly relevant to the global supply chain. So I think it's going to be a combination of rate sensitives, discretionary spending, capex, investment plays, and selectively export or global plays. I think a combination of all of this are expected to outperform.
Combination of a lot of factors, but what's also impacting the market at this point of time, Nilesh, is the clear divergent moves coming in the broader markets versus large caps. It's the mid cap and small caps that have been outperforming, while the likes of Reliance, HDFC twins, they have really failed to participate. What's your view on Reliance and the HDFC twins at large?
Well, both the packs have consolidated quite a bit, and clearly we see a lot of value emerging there. Especially the HDFC twins, they basically are currently countering a bit of a technical overhang in terms of what the MSCI's decision was in terms of the inclusion and their respective weights. So that is an overhang, and the merger is just around the corner. So I believe that maybe for some time these overhangs may persist, but I still believe that the earnings season, I think, has been great for both of them, and you're seeing them to kind of become more reasonable on valuation. So I think they are attractive for a long-term investor. We own these in our PMS, so we have a vested interest.
The vested interest, but what are you doing with your positions? Are you looking at this consolidation as an opportunity to add, or you're just holding on to your position?
We are holding on and adding as well. So we're using these essentially this phase of consolidation or even bit of the declines to keep adding to these positions, because we still believe that these are really some strong giants. They are stalwarts, and they continue to kind of deliver cutting edge products and services. So to that extent, on the whole, we really like the long-term investment thesis for some of these established companies.
Nilesh, anyone who's everyone is just betting on the entire manufacturing theme, talking about how this is the next big sector to bet on when it comes to India. I'm sure you too have jumped onto the bandwagon. Tell us a little bit more if you have, and what exactly is it that you would look at from a market standpoint?
Well, this decade should witness the emergence of India manufacturing. Lots has been done in the last 5 to 7 years to make Indian manufacturing competitive. And these reforms are essentially going to propel India's manufacturing to new levels and new heights. For many decades, the share of manufacturing in our GDP has essentially been either falling or has been abysmally low, and it's time for the manufacturing sector to catch up. And thankfully, several policy measures and reforms have been unleashed in the last 5 to 7 years, which make Indian manufacturing very competitive. So in addition to the China plus angle, I clearly believe that it's become imperative for global supply chains to de-risk their outsourcing, and India clearly is a very strong destination. We've seen some really big players come in and expand their manufacturing and outsourcing from India. The likes of Apple, Tesla is continuously knocking on the door and evaluating options. And in addition to some of these really technology or the new age companies, we also seeing manufacturing pick up strongly in chemicals, pharmaceuticals, auto components, defense. These are some of the areas where Indian manufacturing is becoming is really becoming the focus of the world. So I think on the whole, manufacturing is a huge canvas. There are several sectors, and we really see majority of these sectors to do well. And especially with the kind of cost proposition that some of the Indian manufacturers have to offer, we think that a combination of a strong domestic opportunity, import substitution, and export promotion, I think are really wonderful kind of areas to look for from an Indian manufacturing point of view.
Nilesh, I also wanted to talk to you about the fact that you have quite a few positions when it comes to the liquor industry. You owned at least United Spirits, Radico Khaitan. You were looking at Sula as well. What's the update with respect to that? And I'm also keen to understand, what's the view on Pharma? Are you looking at it incrementally positive?
Firstly, on the alcoholic beverages, we're extremely constructive, extremely positive on the Indian alcoholic beverages segment. We pretty much think that this sector is pretty much like what consumer staples like soaps and shampoos were 10, 20, 30 years back. Underpenetration is abysmally low, and we have a lot of headroom to catch up. So there's a solid case for these businesses to kind of compound or grow their volumes in high single digits and value in mid double digits. So we clearly believe that this is an extremely attractive opportunity. We used to own United Spirits as well as Radico. We continue to own them, and we have most recently added Sula, as it is the market leader in the wine segment, which is still kind of very, very nascent and in very early stages. So we own these three positions in the Indian alcoholic beverages, and we think it's one of the best proxies for Indian consumption story. And as per capita incomes rise, we actually believe an increasing consumption of some of these discretionary products. So clearly continue to be very positive on that. Secondly, is in the liquor segment, we think margins have bottomed out. And when we kind of look at the guidance which some of these companies are giving, they're talking of getting back to their historically high margins over the span of next few quarters or next few years. So that will provide additional tailwinds to the growth for these companies. Coming on to Pharma, I think Pharma has so far been a very disappointing experience. They continue to face some strong headwinds in terms of price erosion, especially for the US markets and some of the regulatory issues. So I still think at this stage, we're not as constructive on Pharma as what we used to be a while back. But let's see how things unfold. If some of these headwinds recede, then we're willing to kind of have a fresh look at Indian Pharma.
That's about the Dawa and the Daru. But Nilesh, what's the view on food, etc. as well? And I'm talking about the fact that if you're having too much Daru, you need the insurance policies from the likes of PB Fintech and probably some Chakna from the likes of Zomato.
Oh yeah, absolutely, Alisha. These are really the kind of opportunities that we are looking for. We like the insurance space, and we clearly believe that Indian insurance is again significantly underpenetrated. Our per capita spending on insurance is just about $80 versus a global average of $800. So that gives basically headroom for growth for several years or maybe for a decade or two. And within that, online insurance is again relatively underpenetrated, or the share of online insurance is still very low. It's still probably 1 to 2% versus maybe 5 to 10 to 13% for countries like China and the United States. So clearly, there's a very strong, compelling growth proposition for online insurance. We have been liking PB Fintech. We continue to own PB Fintech. On the food side, yes, clearly we still believe that the food basket itself of the average Indian consumer is changing, and some from the basic staples, I think it's moving on to some of the different kinds of foods. And I think within that, we have been owning Pratap Snacks for a while, and a year back approximately, we'd added Mrs. Bector as well. We continue to like these, though of course post the run-up, the valuations have gone on to a bit of the higher side. But let's see. I think on the whole, we like these kind of opportunities where the plate of the Indian consumer is changing, the consumption basket is changing, and we're continuously evaluating opportunities on them in this space.
Daru and snacks in the portfolio, so hopefully it's going to turn out to be very tempting returns overall. But Nilesh, let's talk IT as well, because you have said in the past that Tech Mahindra, has the pedigree of the M&M group, so that's a stock that you're looking at. What else have you been adding when it comes to mid-cap IT?
Well, we haven't yet, invested in Tech Mahindra. We continue to evaluate it. It's on our radar. Yes, we like the fact that it's part of the M&M group. So I think the pedigree is fantastic. They clearly have an edge in the telecom space, but yet that has yet to translate into industry-beating numbers. Going forward, there is a change of leadership, and sometime you're going to see a new CEO take over during the course of this year. So we'll really see what he has in store for Tech Mahindra and its growth prospects, and whether he's able to really catapult Tech Mahindra into a new growth orbit. So we continue to basically still watch that space and watch the company. So let's see. In the mid-cap space, we continue to like the entire mid-cap space. I think there are some really compelling opportunities, of which the most constructive that we are on is been LTTS. We've been owning it now for a while. We continue to like what they do in the engineering R&D space. However, there have been a couple of developments which are likely to kind of, in a way, flatten their growth maybe for a few quarters before they really catch up with their past historical averages in terms of both growth as well as margins. So we continue to like that for what they do and the leadership there. And we continue to evaluate many other mid-cap and small-cap IT companies.
I want to come back to the point that you were talking about in terms of consumption, how is underpenetrated, and we have seen that the luxury end of the market and the per capita income increasing, that entire wealth effect is having an impact on the trends in consumption as well. So how would you like to play this with respect to real estate, if at all, and autos?
So real estate is essentially a sector which is really poised for much better times. We think with softening in commodity prices and inflation lowering, interest rates are probably have either peaked out or are likely to kind of trend lower, which I think is going to be a stimulus or a catalyst for the real estate sector. The sector itself has gone through consolidation for the last 9 to 10 years. And we think that, like any other sector, this sector is also expected to emerge out of this consolidation phase. So we are constructive on the real estate space. So far, the luxury segment has done well, but we believe that with broad-based growth, pickup in manufacturing, wider job creation, we think that now the affordable real estate space, or the mid-income real estate space, is also expected to play a catch-up to what the premium of the luxury end has been doing. So we think on the whole, the real estate space, I think, again, is a great proxy for both India's consumption potential as well as in the short to medium term on where potentially interest rates could be headed. So I think we like the real estate space.
I know we did touch upon PB FinTech, Nilesh, but just curious as to whether or not, any of the other upcoming IPOs or some of the other, new age tech companies are appealing, or what your view is as a whole.
So, Aman, that's an interesting question. That's a great question. And I think we are excited about, the potential for some of these new age companies. And we have been constructing on the space. But I think when we have continuously evaluated them over maybe the last 6 to 8 quarters that they have been listed, earlier on, they were just focused on growth. And in the process, they were essentially incurring losses and maybe having cash burn as well. They have recalibrated their strategy, taken a few steps back, and chose to focus more on profitability, which is good news, because I think respecting the balance sheet, I think for us, is a very, very important tenet of running a business. But having said that, I think it's impacting growth for some of them. And I think in the most recent quarter, some of them have kind of reported a tad lower growth than what you would want to expect them to do. So let's see. I still think that some of these new age companies are still in an experimentation mode, and I think are trying to kind of still dabble between profitability and growth. So let's see. We're watchful of the space. The moment we basically we get answers to some of these questions, I think we would probably have more of them in our portfolio.
What about the entire capex-led industrial growth theme that is playing out in the market at this point of time? The likes of L&T, the industrials, Thermax, Cummins of the world. Something on your radar, or not really?
Oh, absolutely. We've been very constructive on the entire capex cycle now for more than a year, maybe a year and a half. And we've had some really interesting picks out there. They've been part of our portfolios, and these have done well for us. So we like the space, just that in the entire CapEx space, we are more inclined towards the product companies or the equipment companies versus, the pure services companies. So I think that's where we have gravitated towards. And we own a bunch of them, which are proxies for power sector, energy sector, railways as a sector. So I think we own a fair bit of these CapEx companies, and we have a fair exposure to them.
Which are those names, if I may ask? You own a bunch of them, so at least name a few.
Well, we own KSB Pumps, we own Hitachi Energy, we own TD Power. These are some of the names that we own. We used to own CG Power, but we have exited CG Power given the kind of sharp run up that CG Power has witnessed. So I think we own a bunch of them.
So you're talking positively about a whole host of sectors, Nilesh. So what's the space you are underweight on at this point of time, or something that you will stay away? What stands out?
I think I'm not too sure about where we're staying away from, but where we underweight are, the chemical space. We are underweight the pharma space. We are underweight the large cap IT space. It's not that we don't have exposure here, but we do have exposure. But I'd say that we're probably significantly underweight on these sectors. We are underweight yet on PSUs as a pack. We are underweight on the large cap banks. We do have positions, but I think we're relatively underweight on the large cap banks as well.
So when you say you're staying away from PSU names, is it specifically PSU banks as well? Because that was the darling of the market in the year gone by. Solid rally. What's keeping you away?
Yeah, so PSU banks as a space is something that we've stayed away from. It's probably because we had sufficient choice in private sector banks across large banks as well as mid-sized banks. And some of the mid-sized to small-sized banks have essentially done probably as well, both in terms of their operating and financial performance, as well as in terms of stock price performance. So honestly, we have been able to participate in the overall banking space. It's just that because of that, there was choice in terms of the private sector names. We've been in the private bank space, and we have fair bit of exposure in terms of the number of names out there as well. It's just that we have a more balanced exposure in private banks towards both large cap as well as mid cap banks.
What about metals? Is that a space that you're steering clear from?
Oh, absolutely. I mean, we've one sector or one space that we stay away from is commodities. We really have no wherewithal to predict where commodity prices are going to be and how that would translate into growth and earnings for commodity producers. So we've stayed away totally from commodity companies, including metals or crude oil producers. And by and large, we've stayed away or have been underweight on some of these cyclicals as well.
Come back to your point when you mentioned that real estate is one of the best proxies to play the consumption trend also at this point of time. What are those names? Are you playing it specifically with respect to some micro markets? And is it, trickling down to, let's say, the cement, the building material, the consumer durable names as well?
Yeah, it's a combination of all of these, what you mentioned. So we've been owning Kolte Patil in the real estate space now for a while. And we continue to like in terms of its execution, what it's been doing in micro markets like Pune and some of the emerging markets like Bangalore and Mumbai for it. So I think we like that. We like its business model about redevelopment and an asset light strategy. So I think we've been constructing there. Most recently, about a few months back in building materials, if you call it building materials, we'd added a laminate manufacturing company. So that's done well. It's delivered strong performance. We also own a housing finance company called Home First. It's in the affordable housing segment, I think doing incredibly well in the outskirts of tier 1 cities and in tier 2, tier 3 cities. It's been growing at a ferocious pace, managing its asset quality well. And it has sufficient capital to essentially grow at these kind of rates for maybe the next 3 to 5 years, with ROEs continuously improving. So we own that as well. In consumer appliances and consumer durables, we've been owning TTK Prestige. Demand, of course, has been somber for this space, especially the kitchen appliances space, with margin pressures coming on. But we think that probably things might start to look up sometime during the second half of this financial year for some of these kind of companies, the consumer durables, as growth picks up and margins begin to kind of start to lift up. So I think we have a pretty comprehensive exposure in terms of real estate developers, housing finance companies, building materials, as well as consumer appliances companies, as I think an overall aggregate proxy for real estate and consumption in India.
Things looking good. I think the entire hospitality QSR space has been a very promising sector of late. Do you own anything within this space? Can you just highlight the themes?
We don't directly own any of the QSR names because some of them are either loss-making or some of them trade at some really lofty valuations. And our strategy is more about trying to kind of buy into growth at more reasonable or favorable prices. But the way we've participated in the QSR space is to be through a proxy play. So I earlier alluded to Mrs. Bector, which of course has the biscuits business, but also has a very interesting bakery business. And they supply, buns and some of the other bakery products to most of the leading QSR chains in India. So to some extent, we have proxy to the fast-growing QSR space of India.
On that note, we'll let you go. Really appreciate you joining us and helping us decode all that's going on as far as Envision's mind is concerned in terms of which are the sectors that look good and which are the ones that one should stay clear of.
Thank you. Thank you.
Thank you. But shifting focus to the big event and the mega event which all of us have been waiting for, and that's the India Economic Conclave. It's going to start in an hour from here on. What's the mood check like? Because a whole host of politicians, corporate stalwarts, as well as global speakers are going to join today at the IEC. So let's go across to my colleagues Ajay and Sumita, who are there at the ground zero to get a mood check.
Well, that's correct. We are right here with our entire team at the Taj Palace Hotel in New Delhi, where the 9th edition of India Economic Conclave is going to kick off and has kicked off. You can see around me, guests have started pouring in. My entire team and many of the reporting colleagues are also roaming around. It's going to be a big deal. You must have seen how the fourth quarter GDP numbers have actually surprised the street. Not only that, even the earnings season has been much stronger, and that is why barring past couple of trading sessions, the stock markets are jubilated and hovering around all-time highs. And that exactly is going to be the focus of India Economic Conclave. Is India emerging, and the way India is emerging as an economic superpower, which the stock market is already factoring in because market actually discounts the future. Whole host of policymakers, corporates, market men, all are going to be around. I'm going to watch out for commentary coming in from our Mr. Amit Shah, our minister, and of course Yogi Adityanath, Jyotiraditya Scindia would also be here. A lot of policy makers, what kind of stuff they are doing on their side. In fact, my reporting colleagues would also be tracking big commentary coming in from a lot of corporates, right?
Absolutely, Ajay. We'll, of course, be chasing not just the big political newsmakers, but also the business newsmakers as well. So we have Ajay Piramal coming in. We also have Anil Agarwal of Vedanta coming in. We also have Shankar Sharma from the markets and Mark Mobius coming in to give us a perspective of how the world is sort of perceiving India. India is emerging as really a superpower as far as the economic development is concerned. Everybody is looking at India to invest. So I think that's going to be the key highlight of today's sessions, and also, of course, how India sort of stands up against China. So I think those are some of the key discussions that we are going to have.
That's correct. That's correct. And you will get to see all the action, watch all the commentary and big voices on ET Now and ET Now Sadesh all the next two days.
Oh, yes, indeed. And we'll be watching out for all those snapshots. Do remember, this is the theme for the India Economic Conclave as we move on the path of integrated equitable development, which is all-inclusive. And the agenda is India, the emerging third superpower. Some of the biggest voices will be converging from politics, global markets, the corporate world, and the economy. So do catch all the action right here on the Times Network. Staying on with us, still tune into First Trades. I just want to mark some of the stocks as well that are in the spotlight in today's trading session then. And just pulling up some names within the Nifty 500. And here's what's standing out in trade. You've got the likes of... apologies, just refreshing my screen. So an Aarti Drugs, that's something that's a buzz in trade this morning. Other than that, you've also got some of the buzzers that include an EPL, PNB Housing, Indus Stars is up about 4% in today's trading session. Take a look at Havells as well, which has spiked up about 3%. Keep an eye out on L&T. Despite the kind of underperformance we've witnessed in the last month, that stock has definitely been moving from strength to strength of late, and there's been another award win for L&T Construction. Actually, they're looking to create renewable energy infra for the largest green hydrogen plant, and the value of that is at about $2.7 billion. So sizable there for L&T, which has been on an order winning spree of late. Well, let's shift gears then, and very literally, and talk to the management of Landmark Cars. Sanjay Thakkar is now joining in to talk a little bit more about luxury cars that have been selling like hotcakes, and of course, focus on EVs and their own performance. Thank you so much for taking time out. Just going to start off by talking about the trend that we've seen for FY23 with luxury cars. Clearly, after a record year, what is the outlook for FY24? Is demand looking promising?
So thanks for having me on the show. The year 23, though we had the best ever year for luxury cars and also for the Indian automotive market, one needs to bear in mind that this was on the back of severe supply shortages, the chip shortage and the Ukraine war, which kind of hampered the supply chain across the world. If it was not for that, the numbers would have been much higher, not only for us, but also for the entire premium and luxury industry. So as we enter into the year 24, the availability, I'm hoping will be much more than what we had in the year 23. And the mood on the ground remains to be quite solid. So all in all, a good time to be around.
And I'm very excited, Sanjay, to hear out about your partnership with MG Motor as well as BYD as well, because we are seeing a lot of MG Motor cars around us, and BYD, if I remember it right, is one of the top picks from Charlie Munger of Berkshire Hathaway. He's quite positive on the counter. Tell us, how's been the traction so far in India?
Yeah, so as far as BYD is concerned, they are early days, and some of the models need to be homologated. So really the traction will happen in the years to come. No big deals right now, except that they are clearly the market leader around the world, and I'm sure they will do well. They have spoken about capturing a good amount of EV market where when India becomes EV. And as far as MG is concerned, it is early days. We just got the LOI, and one of our subsidiaries, which will be headed by my son, will be looking at it. So we'll see how that pans out, though we are extremely happy with this association.
To build up a bit on that, so it's early days for MG Motor partnership, and I understand it's only 2 stores for now. How are you looking at scaling up? What's the store addition plan, and how do you see the growth or the contribution from these cars panning out, let's say 12 to 24 months out?
So in our case, I think the growth is going to come from multiple sources. What needs to be seen is that our average selling price, what the cars that we sold last year, we are now selling cars worth nearly 18 lakh rupees at an average, which was just 14 lakh rupees a year back. So we have got a 25% jump on the average selling price of the cars that we sell. The cars that we service, that average selling price of the service that we undertake has also gone from 21,000 odd to 23,500 rupees. So there is a 10% jump over there. So the growth for the company will come from several things. The average selling price going up, the volumes going up, and the service revenue, which has always been a solid source of what we are doing. So which has been growing at 20% CAGR for the last 9 years. It actually grew at 25% last year. So we have a heady cocktail of things which are happening. And we also don't forget that we have the Honda Elevate, the new car getting launched, the Mercedes-Benz GLC, which will be launched during the year. So a lot of cars which were as such not available is something that we are looking at to propel our growth.
What about EVs in terms of how they've been selling off late? Which are some of the latest models? The Hyundai Ioniq, for instance, Mercedes-Benz now with their new electric vehicles, 4 of them. How are they selling, and how much of share of your total revenue pie now comes from EVs? How do you see that growing?
Yeah, so I think India, as far as the EVs are concerned, is at a nascent stage currently. And as far as Mercedes-Benz is concerned, it's been stated publicly that within the next 4 years, the EV contribution will jump to 25% of all the cars that we are selling. So the cars that have been introduced right now, the EQB and the EQS, which have been, they are doing pretty well currently, and the volumes will only grow. I think the Indian market, we are at around, I think 1.5% of the total market, which is EV for India. The global average is much higher, and it is, I think the EV acceleration will happen maybe 2-3 years down the line, where more models are made available by the mainstream car manufacturers, and the volumes will gradually pick up. That's the view that we have at Landmark.
You talked about the fact that growth would be on account of multiple levers, for instance, the increase in the average selling price that you talked about. When I was speaking with Santosh of Mercedes at the start of the year, he did point out that they're expecting a double-digit growth perhaps in the year. From 16,000 units sold annually, they're looking at maybe 18 to 20,000 soon. What's your take of what the volume growth could be in the year, and any more tie-ups lined up apart from, let's say, the MG and the BYD, which is in process?
As Santosh is the correct person to kind of predict the volumes for the company. On ground, we are fully supportive of these numbers being achieved. The supply remains to be something that we wish was better. The demand continues to be strong on the ground. So we should be looking at India as a story which is a multi-year story, a 10-year out. What is it that we can be? Today, the luxury market is only around 1% of the overall market. Last year, we sold 4 million vehicles. Luxury was 40,000 vehicles. Now, this is really a very, very small, insignificant figure, and this can significantly grow over a period of time. So we at Landmark are looking at playing a long-term game, not looking only at this quarter or the year, but how will it be 5 years out, 10 years out, and we are building on something which will be monumental. That's the view we have, and that's how we are positioning our company.
And the after sales that you talked about, it continues to be a steady revenue generator, but any sense that you could give us in terms of what's the mix at this point of time, what could be the contribution going forward, and overall what will it do to your margins?
Yeah, so that is a business which is compounding, as I said, at 20% CAGR for the last 9 years. Our service, the after sales billing was around 750 crores last year with more than an 18% EBITDA. Now this grew at 25% year on year between 22 and 23. So we are hoping that this keeps on, we are quite confident that this will keep on compounding. And we believe that this is a kind of an annuity business that we are building. The cars that we put on the road, then they give us revenue for the next 5, 6, 7 years. The accidents that happen in India are also not small. 1 in 3 cars that you see on the road meets with some or the other accident every year. Now that is something which will keep on happening, and this is something which we believe will be a very big driver in our profitability. And mind you, our profitability has grown significantly year on year. We have declared a dividend of 45%. So this is our first year, and we would like to build from here.
Thanks so much, Sanjay, for joining in and taking time out, giving us a sense as to what's been selling when it comes to autos, as well as how business is shaping up for you. 18,577, so not bad, and it's clearly the small cap end of the market that continues to scale up in trade. But let's move right on. Gas stocks as well in the spotlight. Saudi Aramco has sharply cut prices of propane stocks, which could shift demand from gas to propane. This would hurt companies like GAIL, Gujarat Gas. Okay, we'll be taking it across to Somi to understand a little bit more. But in the meantime, we've got the management of JK Cement joining in to talk about the outlook on pricing, demand, and what the view is for the company. Ajay Kumar Saraugi is the Deputy Managing Director and CFO. Thank you so much for taking time out and joining in on ET Now. What is the outlook in terms of your on-ground demand at present as we're stepping into the monsoon season? How are you expecting it to shape up?
Yeah, so the demand is good at this point of time. And yes, there has been some hiccups because of unprecedented rains and weather conditions. So otherwise, we foresee that the demand in this fiscal should go around in double digits for 9 to 10%. And as far as our company is concerned, we expect our growth to be around 15%.
And is the volume growth, Mr. Saraugi, or this is the combined growth value plus volume that you're looking at?
Volume growth for our business.
Sure. Point taken. Could you also talk to us about how the pricing is really panning out? We understand that the industry managed to take a price hike in the month of May. April also saw a bit of an uptick, and there's further price hikes expected in June. Could you clarify and confirm that for us?
So as of now, there's no price increase. We have to see, the demand is good. We made that since there has been a cost pressure, there is a need for a price increase, but it will really depend how the market takes it.
Any sense in terms of how the pricing has really panned out in the last 3 to 6 months, and overall the number of cost increases that you've done or price increases that you have done, is it enough to pass on the pricing pressure of the raw materials that you talked about?
So if you see in the last fiscal, the cost increases have been far more than, the cost increase has been far more than the price, and that has affected the margins. But now, though there's an effort, we have to see, because a lot of capacities have also come in, and effort is there to pass on the cost increase. But at the same time, we are seeing some silver lining as there is some reduction in the fuel pricing. So we expect that at least some relief is there, but the industry definitely needs some price increase.
Right. Your EBITDA per ton in Q4 was about 750 rupees per ton. What is the outlook on a QOQ basis?
So now we expect, the EBITDA to definitely improve going forward, and there should be, some improvement in EBITDA in this quarter, and even when going forward, we should be able to achieve an EBITDA growth of closer to 1,000 rupees.
Per ton you're expecting in, let's say, Q1, Q2 itself, or towards the fag end of the year?
Towards the fag end of the year, not in Q1, Q2.
We understand that, of course, the company is looking at foraying into the paint segment as well. So could you talk to us about what's the update? When will we see the rollouts in a big way? When are you expecting the commissioning of the plants, etc.?
So, see, we have acquired a paint company. So now we are just increasing the reach of the paint. And the last year, this paint company does an annual turnover of about 90 crores. And this year, we expect that, we could be doing at least about close to 100% increase in the top line.
Okay, separately, there is a lot of consolidation which really continues in the sector. Are you looking out and scouting for any acquisition opportunities? And if yes, which areas, which other companies?
No, at this point of time, no, we're not looking out for any opportunities.
Okay. Not looking out for any opportunities, but the debt continues to be a bit elevated around that 2,900 crore levels on a net basis. What's the trend expected to be when it comes to net debt going forward? Any debt reduction plans that you can highlight?
So see, the net debt is there because we just completed an expansion, but I think this has peaked out, and going forward, it will reduce.
And sir, Mr. Sarag, if I can get that clarification right, you said you're not looking for any opportunities, but there was a chatter that probably Sanghi Industries is one of the assets which is on the block and you would be interested. Could you confirm or deny?
No, actually, we are not looking at it.
Okay, so that's the take coming in. And okay, let's talk about the capacity expansion as well, because you did point out that there is a lot of supply which is going to come on board. For JK Cement itself, what's the capex plan? What are the capacity addition, whether it's happening in the grey cement, is it happening in white cement?
So we have just we have added about 6 million tons in this in FY23, 4 million tons of greenfield capacity and 2 million tons of brownfield capacity. So now at the end of fiscal FY23, we are at 20 million plus capacity. We have 3.5 million tons greenfield grinding, which is on way, and out of which 1.5 million should get commissioned in this fiscal, and 2 million should get commissioned in the second half of FY25.
All right, thank you for taking time out and giving us some projections on your net debt levels as well as your financials. Moving on to gas stocks then, and let's take it across to Samit to understand what the impact of Saudi Aramco sharply cutting the prices of propane stocks could mean for some of the companies like GAIL and Gujarat Gas. Samit?
Well, Gujarat Gas and GAIL remains in focus, and this is because Saudi Aramco has cut the prices for propane for the month of June. Now, this is a sharp cut of around $105 per metric ton, and the current prices are standard around $450 per metric ton, which is the lowest that we have seen since November 2020, and that is when the crude prices were hovering around the $45 to $50 per barrel mark. Now, this cut in propane prices have been done owing to ample supplies in Middle East and in the US region, and because of lower petrochemical demand coming in from China. Now, the new propane prices in India would be applicable from the 1st of July because there's a 1 month lag usually, and this new prices mean that from the month of July, propane would be around 17 to 18% cheaper compared to the gas prices that we have been seeing in the Morbi region. Now, in Morbi region, Gujarat Gas is the sole supplier of gas to the Morbi region, and if you see the current propane prices that stand at around 39 rupees per MMBTU as compared to the Gujarat Gas's gas prices of around 38.4 rupees per MMBTU. Now, this propane price of 39 rupees could be cheaper by around 18% further, which will mean that Gujarat Gas's margin could take a big hit as against the assumption of around 12 rupees per SCM given the current spot prices of $10. So that is the negative coming in for Gujarat Gas. For GAIL, also lower propane prices means that the realizations for LHC, which is the liquid hydrocarbon, would be lower, and as per analyst, every $100 drop in LPG or propane prices means that GAIL's EBITDA could take a hit of around 5%.
Putting that into perspective, and that's the reason you have Gujarat Gas, which is lower by around 2% in the trading session. Let's flag off some of the other buzzers as well. Aarti Drugs is moving on heavy volumes at this point of time, already 4 times the average that we have seen. Its stock is up almost 4%. PNB Housing is the other one, which is higher by 5%. SL Propack or EPL, that stock is higher by around 7 to 8%. And Laurus Labs, as they have increased their stake in one of the companies and paid around 80 crores for that. That stock too is in focus. It started off with a gain of almost 4 to 5%, cooled off to 2%. Sobha Industries is also something that we should flag out for the case that the stock is higher by around 5%. And then Adani Transmission and Adani Gas, Apollo Hospitals, for instance, that's higher by 4%. And KPIT Tech is sitting at life high levels. So all of these counters in focus. Definitely a lot of action in the broader markets, and Nifty too has managed to recover quite a bit. It's now headed towards that 18,600 mark, very close to the highest point of the trading session. Time now for a quick break on the show, but as we do that, we here at the Times Network are back.
All right, let's move on then. Welcome back. Sohinder Singh Gill is the CEO at Hero Electric and DG SMEV joining in on the show. Thanks so much for taking time out. Good to have you on board. Just wanted to get in your initial thoughts as to what the outlook is when it comes to the price hike post the subsidy cut for that OEMs have announced.
Thank you. We are talking of electric two-wheelers here. and electric two-wheelers are competing with petrol two-wheelers. And currently, before this subsidy reduction, the prices of electric two-wheelers were varying around 30% higher to 80% higher than the petrol two-wheeler. After the subsidy is reduced, if the prices are passed on, many two-wheelers will cost twice as much as petrol two-wheeler. So one can understand now that how many people would like to take a bet on electric two-wheelers as compared to an option of petrol two-wheelers that were there, very good quality, all the 40 years. So perhaps my personal belief is there's going to be a dip, a significant dip, unless companies hold on to the prices somehow and somehow manage the losses on account of that.
Difficult time as far as the the electric two-wheelers are concerned. But Mr. Gill, as to your own expectation, are you expecting some sort of rollback from the government or any other policy intervention that could help negate the impact of lack of subsidy?
Not in the short run, because the government is hard pressed for funding. And the budget was there, the budget was allocated, the budget was over, and they have got additional money also funneled in, but still it is not enough to support the subsidy that was announced 4 years back. So there's no more money available, at least for FAME 2, which is going to run till end of this current financial year. And absolutely there's going to be no intervention of any sort financially to the customer directly, because these are direct customer subsidies, to reduce his price of adoption. What may come later in the next financial year is some sort of an indirect support, which is obviously another thing which is very much required, whether it is infrastructure support in terms of charging or otherwise skill building, or PLI support to some of the companies to have incentives linked to production. Those are the indirect things. But I think the customer subsidy, once they are tapered, they can't be brought back. They may continue to be at that level from next financial year in the new FAME 3.
Mr. Gill, if you could give us a sense as to what was the sales momentum of the entire electric two-wheeler industry, let's say in the year gone by, and when you say we can expect a sharp dip, what could that number fall down to in the coming year?
At such a low volume, one has to compare not year on year, one has to compare to the targets the country set for itself or the organization set for themselves. Niti Aayog had declared a target, many private organizations had declared a target of, for example, 1.2 million last year, at least two-wheelers who should be on the road to be on the exponential path that we had thought for ourselves. Against 1.2 million in the last financial year as a target of Niti Aayog, the industry did only 725,000. So in percentage term, it's a huge shortfall and it is nowhere near the sort of a trajectory of growth. This year, the target of Niti Aayog and many others was 2.3 million or above. So while the industry may clock more than the last year, more than 725,000, maybe industry will do 1.2 million, but it will be 50% of the so-called trajectory that we should have at 2.3 million, which means the trajectory has been just snubbed to what it should have been. Because mind you, we are all aiming for a complete transformation from petrol or a dirty fuel to electric in 7-8 years. And in short to mid-term, we are thinking of a 30% conversion of petrol to electric, and 30% of 1.6 million is 5 million. So in another 2 years, industry is expected to do 5 million. I think that will be a difficult task given the support that has been withdrawn suddenly and sharply.
But you did point out to the fact that the companies will have to take price hikes. The likes of Ola have already announced price hikes to the tune of 15 to 30,000. What about Hero Electric? Are you looking at some sort of price hikes, or are you going to absorb that and that is probably something going to impact your profitability?
See, I have already announced the first one to say I'm not going to increase the prices, at least for the time being, till the time I sustain, because I can't be giving, I'm there in the market for 15 years now. And there are so many headwinds we have faced all along. Suddenly policies going adversely or favorably. So you can't change your business strategies and customer adoption, customer profiling with these type of things that happen suddenly because of policy interventions. So I announced 3 days back that we will not increase the prices. We'll try and sustain it because the motive today is not to make money here. We have been making losses all 15 years. The motive is to increase the category, increase the presence, increase the adoption. And a sudden U-turn will be very adverse for the country and adverse for the sort of industry also. So we believe some of the guys who have even done the price increases have not passed on entirely whatever the losses were. They have also tried to reduce the loss due to subsidy reduction, and midway they have increased the prices. So perhaps there is going to be middle path. The demand will come down, but may not fall very sharply if companies decide not to increase prices or to reduce, slightly reduce the increases.
Mr. Gilbert, doesn't sound like a very sustainable model, right? Yes, you've been running losses, but at some point, the point of view is to generate profits, right? So, A, could you highlight to us what could be the long-term strategy then of the industry? And secondly, what's the price differential right now of hero products versus the other in the market?
Well, my prices today, the most popular product I'm selling today from now onwards, from 1st of is going to be 1,30,000. So that is the price of the model, which is around 60% of the volume. The market is moving, I think, from 1.45 lakhs to 200,000, 2 lakh. That's the price band I'm seeing people emerging as far as the bikes generally are concerned. So there is a spectrum of prices from maybe 1.2 lakhs to 2 lakhs we will see unfolding in some time from now. As far as losses and profits are concerned, it's not a question of how many years you will make losses. It's how much losses you will contain to be able to continue. And the trick here is to do the product which is value for money, not really add too much of features, gizmos to make it outrightly outpriced. Also reduce your overheads and not waste your money in a lot of marketing expenses or a lot of frills and fancies. So we have been adopting a sort of a frugal model, even organizationally and network. And I'm happy to say that my network in the last 10 years is with me, and many of them are broken even or making money out of it. I'm going to be EBITDA positive towards the end of the year, this year, even with this type of a price absorption that I have done. So one has to see the business models of where do you want your organization strategically. Is it a passion that you are following, or a pure financial price play that you are doing, or a financial model that you are following?
Sure, Mr. Gill, thank you so much for joining us. So at least we'll be EBITDA positive by the end of the year, and right now not increasing prices because the idea is to expand the market. Thank you, Mr. Gill, for joining us and talking to us about how the industry thematics are panning out at this point of time. Well, let's welcome on board our technical experts as well for our Chartbusters segment. Kunal, what's the chart on your radar?
Well, Havells is a chart, and I think it's an excellent chart, Anisha, because the stock is showing all those classic ingredients of technical parameters which you look out for: price pattern breakouts, volume built up, indicators showing signs of strength. All of that is positive. What I'm looking at the charts for Havells is more on the medium-term aspect, because the stock is forming a triangular pattern breakout. Now, this is the range for Havells since 2021, where the stock formed a low which was around the sub-1000 mark, around 900, 950 levels. And on the upside, this was 1500 for the stock price. As you can see that over the last 2 years specifically, the range for the stock has gotten a lot more contracted. The stock has time and again taken resistance as well as supports at the upper end as well as the lower end of this sloping trend line. And now the stock is getting ready for a breakout. So trading about 1345, 1350 mark, I think this could be a strong confirmation of a breakout and an end of almost 2 years of a contracting range for Havells. This breakout potentially could lead the stock not just retesting towards the 1500 mark, but I think going much beyond those levels. So extremely bullish on Havells over the very near term, and expecting the stock to not just scale past about the previous highs, but go much beyond that as well.
Okay, Havells it is. Moving on then, Naresh, let's find out what your chartbuster idea is.
So that would be a chart for Bharat Forge. Now, if we look at the chart, the stock has been consolidating for quite some time. In the near term, it has made a base around 750, 760 levels. You can see there are 4 attempts around that area, 3 to 4 attempts. And the interim highs are around 810. And 800 as a price point has been a problem for a long term. 2018 was the high over there. We broke out about those levels, about 800, 810, went to 900. tried to sustain, then again pulled back to the lower zones again. Now again we could be starting a fresh trend here. So the risk reward looks promising, preempting that breakout above 800, 810. Once that happens, we could be going towards 900 to 1100 levels. So a buy at current levels with a stop loss at 780 and a target price of 900 plus.
So Bharat Forge is the counter on Naresh's radar, and Havels is something that Kunal is suggesting at this point of time. But what are the other top ideas coming in? Kunal, tell us more.
So two banking names, one from the PSU banking lot. PNB is a stock which I would recommend to buy. Targets of 56, stop loss at 48. And IDFC First Bank is also perched at a fresh swing high for itself, about that 71.5 mark. So buy with a target of 78, stop loss at 69.
Naresh, what about you? What are the other top stock recommendations?
So first is a buy on Indus Towers. The stock saw huge selling yesterday due to MSCI. The interim highs for the near term are at 160. Stock is trying to cross that today. Stop loss at 155 and a target price of 175. Second is a buy on Apollo Hospitals, which has continued the breakout first above 4,500 and now above 4,800. A stop loss at 4,650 now and a target price of 5,200.
All right, thanks very much for that. And we at the Times Network were back with IEC to drive India's economic agenda on the path of equitable development, which is all-inclusive and strengthens not just the Indian economy but the global one as well. India, the emerging third superpower, is our theme. Tune in to get a glimpse of some of the biggest voices from politics, global markets, the economy and the corporate world.